Hi, welcome back. You got O'Connor again, and we are looking at learning module, chapter 11. And look where we are. Holy moly, we have gone right around our hexagon here, this framework, forensic accounting, but we're into what area now? We are looking at financial statement fraud. And this is an exciting one. Why? Because this is where all the loot is lost in organizations around the world through financial statement fraud. And you got to believe me. Let me make a few points. Number one, we have changed our triangle. Right now, you're going to be seeing pressure, opportunity, and rationalization every week, right? We're getting back to the basic fraud motivation triangle. We're moving away from your acts of investigation, the theft act, the conversion, and the concealment. All right. So notice that. The second thing you need to notice, financial statement fraud makes up most loss due to fraud. And it is management fraud on behalf of the firm. And I would call it fraud on steroids. You've got to believe me. All right, so let's get into chapter 11. We're going to look at the problem of financial statement fraud. We're going to throw you lots of examples or data that I've collected on financial statement fraud. We're going to look at professional skepticism. We're going to look at the fraud exposure rectangle and critical questions about financial statement relationships. Now, note this. This is the prelude to the next two chapters or learning modules, chapter 12 and chapter 13, where we go into more detail of the mechanics of what to look for in financial statements. So see this module as a way to get motivated that this is why we need to nip this in the bud before it gets even worse. And it is pretty bad, as we say. What are you going to learn? You're going to discuss the role of financial statements, what they play in capital markets, the nature of financial statement fraud, become familiar with financial statement fraud statistics. I'll throw a lot of statistics at you, and see how financial statement frauds occur and are concealed. And we look at a framework for detecting financial statement fraud and identify financial statement fraud exposures. All right. And so at the end of the day, we want to explain how information regarding a company's management of directors, the nature of the organization, its operating characteristics, and financial results can help you, the fraud investigator, the auditor, to assess the likelihood of financial statement fraud, because once it happened, often it is too late. Let's get into it, shall we? And we will break this up into probably at least two videos. So for the first part, we want to look at the problem of financial statement fraud. As I said, it is the biggest fraud of all. They often result in large losses for investors, the lack of trust in the market, and litigation and embarrassment for individuals, at least for the organizations associated with the fraud. Wow. All right. Financial statement fraud in recent years, well, we call it cooking the books. Okay. So the more you cook the books, the greater it tastes. Like we're talking about taste in terms of the fraudster. Can they taste the money? All right. Cooking the books. All right. And it results from inappropriate executive loans, insider trading scandals, IPO favoritism, retirement perks, exorbitant compensation, quid pro quo transactions, excessive debt, and backdating stock options. Not all of these are as prevalent today. And I just want to remind you again, we're just getting back to the basic fraud triangle. That is the pressure, the opportunity, and the rationalization by the fraudster. Now let's have a look at these ideas of financial statement fraud in my diagram here. And the same areas of opportunity as I went through those 8 areas: stock options, executive misconduct, quid pro quo, financial instability, IPO issues. Okay, many of these are still a potential source of fraud today, 2024. However, some of them are less so. Which would they be? Well, I want you to think. Stock options, less likely so. Compensation issues, less likely so. And trading scandals, especially the regulations and having a real-time audit trail of trading. You can uncover trading scandals very, very quickly. Stock options, very easy to see the audit trail, very easy to see backdating. Everyone knows it's likely to occur, so we always look out for it. So that's not going to happen again. And compensation issues. You've got to believe it that boards of directors are much more sensitive to executive compensation issues, more so than ever, because not just regulatory scrutiny, but more because of media scrutiny. All right. A huge payout of executive compensation does not always bode well for the brand name of the products of the company. All right. So even though we list 8 items here that have been associated with financial statement fraud, some of these are less likely to occur going forward because of regulatory and media scrutiny. What about the evidence? I'll bring back to you over these next 3 pages some of the juicy material I've uncovered. That is the 36 top frauds in the last 40 years. And so there are 3 eras. The first era was pre-2000 to 2004, including the dot-com crash. And notice there were a lot of frauds, including the big ones of all, that is WorldCom and Enron. They were ginormous, okay, in the billions, 63 billion for Enron, 11 billion from WorldCom, the biggest out of all these. Pamlat was a big one also, and that was 16 billion. Wow. And they were all, guess this, they were accounting frauds. Wow, you've got to believe me. All right, what about 2004 to 2010? What has happened? Well, of course, Satyam was a huge accounting fraud, but just 1 billion. But what about Lehman Brothers? That they ended up going bankrupt and collapsing, and that was hundreds of billions. So you could say Lehman Brothers was the biggest in the last century because Enron was just 60 billion. Wow. All right. So, and this was misleading accounting. And so accounting is at the heart of these big, giant frauds. Okay. Putting aside the Ponzi scheme of Peter's Group Worldwide and also Bernie Madoff. And I think that is in here somewhere. There we have Bernie Madoff, the Ponzi scheme. You're talking 65 billion, but 18 billion in actual losses because there was a lot of recovery. All right. So that's a huge Ponzi scheme. So you can see that was a Ponzi scheme founded on misleading accounting as well. That's what Ponzi schemes are. Wow. You get new investors in to fraudulently pay out higher returns to investors who are already in your scheme. All right. So basically, in the end, they are misleading accounting. Isn't it great that you are studying accounting? All right. Let's go to the 3rd era, and that is 2010 onwards. And you can see, yes, accounting frauds are still with us. All right. Banksia IPO. Luckin Coffee, that was a big one out of China, IPO in the US, but there was only 300 million. And then Wirecard, that was the biggest in probably the last decade, 2.1 billion, except for FTX, most recent misappropriation of funds, less so an accounting fraud of 8 billion. So you could say that the FTX is the biggest most recently, but Wirecard was one of the biggest accounting frauds in the last decade. You could say Carillion was a big one also, but that was in Europe and most of the others were in the US. All right. So what are we saying here, Neil? These frauds are big. They're bigger than employee asset misappropriation. They're bigger than corruption. They're bigger than fraudulent disbursements and other frauds that tend to occur from day to day, week to week in the organization's operations. These frauds can bring down the whole organization. And it has resulted in the bankruptcy of many organizations in the last 4 decades. Wow. All right. And so just summarizing out of these 32 cases, the elements of a perfect fraud storm, the textbook talks about these 9 elements, but let me show you the evidence that is the most common element of the types of financial statement fraud. Most common was accounting fraud. Next, misuse of corporate funds, rogue trading, Ponzi scheme. That is an accounting fraud, misleading financial reporting, mortgage fraud, money laundering. You can see that they all have hints of accounting. They are not pure accounting, as in these 12 that were associated directly with accounting fraud that you'll learn more about in the coming learning modules. All right. So just get this, that what we see in the data, it's supporting what we are talking about in chapter 11 of the textbook. And why is this hard to detect? The nature of financial statement fraud. Why is it hard to detect? Well, you have conviction challenges. It's very difficult to prove. There are legal complexities. Only 20% of CEOs/CFOs that were indicted in the last 2 decades ended up going to prison. What about the other 80%? So it's very hard to get convictions and people jailed. There is intentional deceit, and there are fraud symptoms, there are red flags, but it doesn't always indicate the presence of financial statement fraud compared to symptoms of employee asset fraud. All right. Remember, you have directors, CEOs, you have CFOs, you have C-suite managers in cahoots manipulating the accounting revenues, the profit and loss of the company. They're kind of working on behalf of the company. It's different from asset misappropriation fraud that we talked about in the past, where you are stealing from the company. So that is part of the reason why it is difficult to detect. And in the end, what we covered in the last 2 or 3 weeks about fraud investigation, financial statement fraud requires investigative analysis. You cannot just rely on preventative measures to stop financial statement fraud. You cannot just rely on fraud detection measures to prevent financial statement fraud. You have to use investigation techniques to add to the first 2 layers. It's easy to stop employee asset misappropriation if you have prevention measures in place, such as creating the right culture and eliminating fraud opportunities. But those things may not stop financial statement fraud because they're usually engineered by C-suite managers at the top. And they are in charge of manipulating the culture. They are in charge of whether fraud opportunities are going to be eliminated or not. That is why financial statement fraud is very difficult to detect. So we can go through this list for why financial statement fraud is difficult to find. But get this, I just want to picture this into a flowchart showing you that the median fraud went from 4 million to 12 million from 1998 to 2007. The average fraud went from 25 million to 400 million US dollars. So the fraud magnitude increased. All right. Executive involvement, CFO, the CEO were named in 89% of the cases. As I said, indictments, only 20% of managers were successfully indicted within 2 years of the fraud. Again, it is also hard to find because of the different board characteristics. Okay, there has been no noticeable difference compared to non-fraud firms. So that is not a symptom. And then auditor changes. I just want you to note here, we are talking about 26% of auditors changed their assignment around the time of the fraud. And that brings us to the next thing I want to bring to your attention. That is, let's blame the auditor. Why? Because we can see with the statistics that 73% of audits had inadequate collection of the data. 47% of audits had an inappropriate opinion, and 54% of audits had inadequate evidence, and 60% of audits demonstrated insufficient skepticism. And 67% of audits showed lack of due care. Wow, we are blaming the auditor. And here I am trying to encourage you to pursue auditing and forensic accounting in your career. All right, we need to gang up and try to find someone to blame, don't we, when we have lost so much money with all of these financial statement frauds. All right, so how do we get around not being blamed as an auditor? First and foremost, you need to have and develop a professional skepticism. That's the minimum requirement before you even start an audit engagement. Now, you've probably learned this in auditing, or you will learn it in auditing, these 6 areas: questioning mindset, self-esteem, suspension of judgment, interpersonal understanding, a search for knowledge, and autonomy. Now, enough of me preaching to you about how you should behave as an auditor. I just want to finish this part with just some more data, just to show you that the motivations for financial statement fraud, getting back to our triangle at the top, remember, opportunity, rationalization, pressure, motivations. In the textbook, it talks about examples of motivations to issue fraudulent financial statements. And they say increase the company's stock price, maximize the bonus, increase personal net worth, meet company expectations. That was the theory in the textbook. Let me show you the data of these 36 top fraud cases. Look at that. 12 of them resulted in personal gain as the main motivation. 10 of those cases were associated with the fraudster having financial pressure or greed to actually improve their lifestyle. Okay, 8 cases were carried out to hide poor performance of the company. That could be because their executive compensation is associated with the poor performance. And finally, there were 6 cases of market manipulation. Wow. All right. So there's the data to support what's in chapter 11 of your textbook. Let me finish this part 1, because I just want you to be motivated and have that energy to really delve into chapter 12 and chapter 13 to say, okay, if I'm going to have any hope of detecting financial statement fraud, what do I need to look for? Where is it in the financial statements do I need to look? All right. So I hope this part has given you that motivation to have that zeal and quest for further knowledge on what to look for in financial statements. See you in part 2 shortly. Bye for now.